Kenya has over 7 million small businesses. Mama mbogas, boda operators, juakali fundis, small shop owners in Githurai, fishmongers in Kisumu, vegetable traders in Kongowea, and hawkers in Tomboya Street. Millions of hardworking people generating real income every single day. Now, when any of these people need money to grow, to buy more stock, to buy a machine, to expand, where do they go? And let's be honest about what happens in the bank. The bank will ask for collateral, a title deed. They'll ask for audited financial records, a formal payslip, a guarantor with a fixed salary, and then they'll take 3 weeks to tell you no. A mama mboga doesn't have a title deed. A boda rider doesn't have audited accounts. A juakali fundi does not have a payslip. So the bank very politely shows them the door. And yet, these people, they need money. They will always need money. The demand never stops. So what happens? Some go to Shylocks, people charging interest so high that by the time you're finished repaying, you've given back double what you had borrowed. Some borrow from friends and ruin relationships. Some just stagnate. The business stays small forever because there was no capital at the right time. This is what economists call a lending gap. And in Kenya, that gap is enormous. Over 80% of small businesses here, they use personal savings or family money as their only source of capital. Only 5.6% get financing from banks. 5.6%. That gap, that massive, hungry, real gap, is exactly the opportunity that microfinance and private lending businesses are built to fill. And that is what today is about. Not just the opportunity, but how to actually do it the right way. From registration, to lending models, to managing risk, to recovering your money. Whether you have savings sitting somewhere, wondering how to make them work, or you're already lending informally and things are getting messy, this is the information you need. So let's get right into it. Before you put a single shilling on the street, you need to decide what kind of lender you want to be. Because not all lending is the same. There are 3 main models. Number 1, individual lending. You lend directly to one person. You assess them, you agree on terms, and they repay. Simple and fast. The risk is, if that one person disappears, you feel it immediately and fully. The second model is group lending. Borrowers form groups of 5 to 10 people and guarantee each other. If one person doesn't pay, the group is accountable. This works beautifully in Kenya because of something banks will never have: community pressure. Research shows that group loan default rates in Kenya, they sit around 5.9% compared to 13.7% for individual loans. That gap exists because nobody wants to be the person who lets down their chama members. Nobody wants that conversation at the next meeting. The third model is salary-based lending. You lend to employed people, the teachers, civil servants, anyone with a predictable monthly income. This one has lower risk because the money comes every month. The challenge is verifying employment and ensuring you're first in line before the other deductions eat the salary. For most people starting out, small business lending is the sweet spot. That one can repay a small loan very quickly. The money moves fast, and so does your portfolio. Pick your model before you start. Don't try to do everything at once. That's how you spread yourself thin and lose focus and money at the same time. I know, when someone says legal requirements, something in the brain just switches off. But stay with me, because this has changed significantly in Kenya, and if you ignore it, you're going to pay for it later. 3 things you have to do. Before anything else, register your business on eCitizen. All business registrations in Kenya, they now happen through the eCitizen platform. Register as a limited company, not just a business name. A limited company gives you credibility, protects you personally if things go wrong, and it makes it easier to open business accounts and form partnerships. Second, understand the new CBK licensing requirements. The Business Laws Amendment Act of 2024 changed everything. The Central Bank of Kenya, it now has authority over all non-deposit taking lenders in Kenya. That means you, whether you're lending through an app, a system, or physically across a table. If your capital is below 20 million shillings, you can register with the CBK. Above 20 million shillings, you need a full license. Registration costs 100,000 shillings as an application fee and 250,000 shillings annually. Operating without any form of CBK recognition is now illegal, and it comes with fines and shutdown. Just do it right from the beginning. It costs less than you think, and it protects you more than you know. And 3, write your loan policies before lending a single shilling. Who qualifies? What's the maximum loan amount? What is the interest rate? What are the repayment terms? What happens when someone is late? And what is your recovery process? If these are not written down and enforced consistently, your business will run on emotions. And emotions in lending is one of the biggest mistakes that you can ever make. Now this is the engine of your business. And if you get it right, you'll be fine. You get it wrong, and it does not matter how many loans you issue, you'll still lose money. This is the interest rates. Your rate needs to cover 4 things simultaneously: the cost of the money you're lending, your operational costs, the loans that won't come back, and your profit margin. For microfinance startups in Kenya, rates typically range between 10% and 20% per loan period. But this is the truth. If you charge 20%, but only 70% of your borrowers repay, you're losing money. You're not even breaking even. The interest from the people who paid does not cover the capital lost from the people who didn't. This is why your recovery rate, it's the most important number in this business. Not what you charge, but what you collect. To stay profitable at 20% interest, aim for at least 90% recovery. At 15%, aim for at least 85%. Below those numbers, your portfolio is bleeding every single month, even while looking busy. There's also a metric called portfolio at risk, PAR. It measures what percentage of your loans are overdue. Keep it below 10%. The moment it goes above that, stop growing and fix your recovery fast. That was for the interest rates. Now, on recovery, let me paint you a picture. You give someone a loan. First month, perfect. Second month, a little late, but they pay. Third month, you're calling. They say nitakulipa next week. Next week comes and you call again. Situation ni ngumu, business imeshuka. You feel sympathetic and you give them some more time. By month 5, they owe you 4 months of arrears and they've stopped picking your calls. This is how it happens. Slowly until it's too late. The fix is being early. It's not even about being harsh. Day 1 of a missed payment, call. Day 3, follow up. Don't wait for 2 months and then try to recover. By then, you're fighting a war. Early intervention is everything in this business. Then, use automated SMS reminders. Before the due date, remind them. On the due date, remind them. On the day after, remind them again. This is not harassment, it's actually a system, and it works. When someone genuinely can't pay, negotiate. Restructure the loan. Maybe they pay less this month and catch up next month. A borrower who is still talking to you and paying something is 100 times better than a borrower who has disappeared completely. As you grow, hire loan officers. Assign each one a defined portfolio of borrowers that they are fully responsible for. People who know the community, know the borrowers, and follow up personally. That local relationship is the most powerful recovery tool that exists in any lending business in Kenya. Now, this is the part that separates the lending businesses that grow from the ones that collapse. It's the system. Most people start with a notebook, some start with Excel. And for the first 20 borrowers, it works fine. But at 50 borrowers, the notebook is getting messy. At 100, honestly, you don't know where you are. Who paid last week? Who has 3 weeks of arrears? Which borrower's loan matures this Friday? I mean, you have no idea. Manual tracking, it leads to calculation errors that cost you money. It also leads to missed repayments that nobody follows up on. Manual tracking leads to reports that take days to prepare and are already outdated by the time you read them. And you're going to have recovery tracking that is basically impossible to do at scale with a pen and paper. This is exactly what a loan management system solves. With the right system, every borrower is registered. Every loan is tracked automatically. Interest is calculated without you touching a calculator. Repayments are recorded the moment they come in. Overdue accounts, they are flagged immediately. And reports, you generate them in seconds. Who has paid? Who hasn't? What your portfolio at risk looks like today, right now, on your phone. That information is the difference between running your business and guessing at your business. This is where Repotrans comes in. Repotrans is a loan management system built specifically for microfinance institutions. You know, the SACCOs, chamas, and private lenders in Kenya. It has borrower registration, loan tracking, M-Pesa payment reconciliation, automated SMS reminders, arrears management, and financial reporting all in one place. It's accessible from your phone, your tablet, or computer. Then it's cloud hosted, so there's no complicated setup. We have institutions that are already using this system, and they're using it because managing a growing loan portfolio manually is dangerous. The numbers get lost, money disappears quietly, and by the time you realize what's happening, the damage is already done. When your system is solid, everything else becomes manageable. You stop guessing and you start knowing. Now, when we come back to where we started, Kenya has millions of people who need credit and they can't get it from banks. That gap is growing, and the people feeling it responsibly and intelligently, they're building real profitable businesses. But the key word here is responsibly and intelligently. This is not a business that you enter with savings and goodwill alone. You need a legal structure, a lending model that fits your market, interest rates that actually sustain you, a recovery system that is early, consistent, and ethical, loan officers as you scale, and a system that gives you real numbers in real time, so you're never operating blind. As you grow, reinvest your interest income back into new loans. Reward borrowers who repay on time with bigger loans in the next cycle. Those people have proven themselves. Treat them well, and they will send you everyone they know. When all of this is in place, your lending business, it will stop feeling like a gamble. This is just Catalina, and I'll see you guys in the next breakdown.